This is the question most investors are not asking correctly. I have been waiting 8 months for the market to dip before investing. The dip has not arrived. The question is, was I right to wait? Who profits from the question, is now a good time to invest? And why does the answer change every single week? This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial professional before making any investment decisions. I told my sister May I was waiting for a correction before investing. She asked, "How long?" I said, 8 months. She said, "That is a long time to sit in cash earning 2.5%. I said, "I know." She said, "I Googled it." I did not like that. 68% of historical periods. One mechanism. One question separates the investor who acts from the one who keeps waiting for the right moment that never arrives. In episode 19, how portfolios drift without you touching them. In episode 20, why bonds failed in 2022. Today, why the investor who stopped waiting beat the one who did not, 68% of the time. I am legally required to mention subscribing. So, subscribe, or wait for the right moment. Either way, the 68% does not change. Vanguard studied every 10-year rolling period from 1976 to 2022. The question was simple. Does investing immediately outperform waiting and investing gradually? Lump sum investing outperformed waiting and investing gradually in 68% of scenarios. Across global markets, across every asset allocation tested, the cost of waiting was measurable. Every time. I have been waiting 8 months. The data says the investor who did not wait beat me in 68% of historical periods. I was not being careful. I was just losing. 68%. That is the percentage of historical 10-year periods in which investing immediately outperformed waiting. The Vanguard research paper, published February 2023. Authors, Megan Finlay and Joseph Zorn. MSCI World Index, 1976 to 2022. The finding, lump sum outperforms in 2/3 of scenarios across every market tested. JP Morgan Asset Management tracked every trading day in the S&P 500 over 20 years. The finding was not what most investors expect. Missing just the 10 best days over 20 years reduced returns by nearly half. An investor who stayed fully invested returned 10.5% annualized. One who missed only those 10 days returned 6.2%. 7 of the 10 best market days occurred within 15 days of the 10 worst market days. The investor who exits to avoid the worst misses the recovery. That is the complete mechanism. If you are in acute financial stress right now, if the anxiety is too high to take even one action today, come back to this episode in a calmer moment. The mechanism will still be here. Your financial situation will not irreversibly worsen between now and next week because you chose to rest today. One action. Log into your ISA or workplace pension today. Enable auto invest or confirm a lump sum amount. Do not wait for the right moment. The data says the right moment is now. If you have a workplace pension, find the contribution rate. Increase it by 1%, 1 percentage point. That is the action. 5 minutes, set it to auto, then leave it. Waiting for the right moment to invest is like waiting for the right moment to plant a tree. The second best time is always today. The best time was yesterday, and the day before, and the 8 months before that. Right, quick one, 30 seconds. Stay with us, this is the part most people miss. The data is unambiguous, waiting costs more than investing. Back into it. Lump sum wins in 68% of scenarios. Dollar cost averaging wins in 32%. The 32% is not random. It clusters around specific conditions. Markets fall immediately after the lump sum is invested. Vanguard research across 10-year rolling periods found that lump sum investing outperformed dollar cost averaging in 68% of scenarios. The cost of waiting is measurable, consistent, and always negative on average. The wrong belief, waiting for the right moment to invest, reduces risk and improves returns. The market is too high or too volatile right now. Timing matters. That belief is not supported by 50 years of data. The 32%, markets that fall immediately after the lump sum is invested. The investor who would panic and sell in week 2, for that investor, dollar cost averaging is the correct choice. Behavior beats mathematics. That is not a contradiction. That is precision. The Vanguard source. Cost averaging, invest now or temporarily hold your cash. February 2023. Megan Finlay and Joseph Zorn. The finding is consistent across every market, every time period, and every asset allocation tested. Financial media generates revenue from the unanswered question, is now a good time to invest? The Vanguard answer has existed since 2012. The question keeps being asked, every week, every quarter, every year. The mechanism is simple. Uncertainty drives content. Certainty ends subscriptions. Vanguard published the answer in 2012. The question about timing has been asked every week since. The business model is the unanswered question. The JP Morgan source. Asset management analysis. Morningstar Direct data. 20-year S&P 500 Total Return Index. Returns based on staying fully invested versus missing the 10 best days. I have watched investors wait for the right moment for 31 years. The right moment always arrives after they have stopped looking for it. I ran the numbers on every 10-year period since 1976. In 68% of cases, investing immediately beat waiting for a dip. I have been waiting for a dip for 8 months. The data says, I was wrong the whole time. Here is the actual lesson. Lump sum wins 68% of the time. If you will panic and sell in week 2, dollar cost averaging is the correct choice. Behavior beats mathematics. That is not a contradiction. That is precision. If a full lump sum today causes anxiety that would lead to selling, invest half now. Add the rest over 3 months. Staying invested matters more than the entry method. The cost of exiting is always higher than the cost of waiting to enter. Set up Auto Invest. Remove the decision entirely. The timing myth only operates if you keep asking whether now is the right time. Stop asking. Set the contribution. Leave it to run. The timing cost. The measurable return penalty paid by investors who waited for the right moment. In 68% of historical periods, there was no right moment. There was only the cost. If financial anxiety consistently prevents investment decisions in a pattern you cannot explain or break alone, that is a clinical signal. The Financial Therapy Association works at the intersection of financial behavior and psychological well-being. One more question before you go. Did you know where you invest matters more than what you invest in? Most people get this backwards. And the answer is simpler than you think. Nadia, Marcus, Maya, Kai. The question, is now a good time to invest, has been answered by 50 years of data. Tell Nadia in the comments, how long have you been waiting? Month and reason. Nadia reads this week. The investor who stopped asking whether now is the right time and invested has already made the structural decision most investors waiting for perfect conditions have still not made. Vanguard published the answer to, is now a good time to invest? In 2012. If this episode saved you 8 months, the like is 1 second. Share with one person who is still waiting for the right moment. They are probably someone you know. 2 episodes that explain what this one builds on. Episode 19 on how portfolios drift without you touching them. Episode 20 on why bonds failed in 2022 and when they actually protect you. Episode 22 is coming, where Marcus reveals why where you invest matters more than what you invest in. Subscribe and you will be notified the moment it drops. And the answer may be simpler than you think. I told my financial advisor I had been waiting for the right moment to invest. He asked, which one? I said, the right one. He said 2019, 2020, 2021, 2022, 2003, or 2024. I wrote down overconfidence bias, then circled it twice, then asked if I wanted to book a follow-up.